The global backdrop is changing like a fast revolving kaleidoscope. 5 weeks back, we never expected war or crude at $130. Today, we aren't sure if we are smelling peace and if crude will go below $100 at all. But we have someone who has thought through the big themes of 2022. We have with us Jitania Kandhari, the Deputy CIO of Morgan Stanley's multi-asset group, and she's also the portfolio manager for active international allocation, also heads macro research and thematic research for the emerging markets equity team at Morgan Stanley, wears many hats, so perhaps best placed to advise us. Thank you very much, Jitania, for joining us. Your read of the 10 big themes of 2022 is excellent, and we will be carrying those themes as we speak with you. But my first question is on inflation. You've said that the inflation genie is out of the bottle as a theme. Now, let us assume that we are at the beginning of the end of the war. Then would you at least say that the worst of inflation is behind us and it will peak off?
$1 million question, Lata. Thanks for having me, firstly. Yes, the inflation genie is indeed out of the bottle. It's not the 1970s, which a lot of market commentators are talking about, but it's not the 2010s either. We are going to settle at much higher levels. So let's talk about what went into the inflation equation. And it was, the accelerated goods demand relative to the services during the pandemic. So there are some elements of that will settle, like car sales, etc., where you had huge inflation showing up. But I think the two most important things that I monitor is wage inflation and also the housing prices, because that feeds into the rental inflation, which lags housing prices. Wage inflation is running at 5%, and I worry about that being stickier and inflation expectations getting de-anchored if that continues to hold up. And secondly, we've seen the highest increase in home prices since 1980 in the US, 15% year-on-year increase. And that feeds into the rental component, which is 30% of the US CPI. So I do worry, and of course, Russia, Ukraine has not helped with the oil and food price escalations that we're going to see. And the zero COVID and shutdowns in China is also going to add pressure. So I think we're going to, the peak is not near yet. It will take a few months before we peak.
Okay. Yes, and possibly we are also not going to see the end of sanctions as soon as the war ends, if it ends, in which case a lot of Russian metals will still not be available to the rest of the world. So maybe you're right, yeah, perhaps the inflation headache will continue. Now, the most interesting theme from an India viewer point of view is your question about whether emerging markets make a comeback. Now, that fits with this inflation theme because the wage price inflation is a US thing and perhaps a Western markets thing. It's not an India thing, it's not an Asia thing. So do you think foreign funds will later on come back to in emerging markets like India?
Yes. So I think emerging markets, just as a starting point, the last decade has been the worst decade for emerging market returns since 1930s. So we are at a very interesting starting point from a performance standpoint. And as you said, yes, markets like India do not have such a significant inflation problem. It's more of a US and even Europe problem because of the gas prices there. I do see some of the poorer countries where food and energy is a large part of the CPI, and where food is imported and energy is primarily imported, you will see inflation issues in some of those smaller countries in EM. But overall, I think emerging markets will see a comeback because it is, at the end of the day, a heterogeneous asset class. And there will be countries like Latin America or the Indonesias, Malaysias that will actually benefit from the commodity price boom, and I am positive there. And there are other pockets where domestic demand in this deglobalizing world, where supply chains are getting domestically oriented, where the world is just turning overall inward, So domestic economies will do well. And China, which is a large part of the index, has also kind of seen the peak regulatory crackdown that was weighing on Chinese and emerging markets. So yes, I do think that at some point, once the dust settles, on the inflation side and on the war side, EM will see a comeback, not only for this year, but for several years.
Okay, you mentioned a lot about commodity producers like Indonesia and South Africa. You mentioned China, the crackdown ended. You didn't mention India. What's the expectation? As a receiver of commodities, you think we won't be beneficiaries of the EM boom?
So, from a relative standpoint, some of the commodity countries will be very high beta kind of plays, right? Because they'll see huge terms of trade positive shocks, which will translate into the domestic liquidity and domestic consumption. So clearly, India is in the middle, I'd say, across the spectrum of the 2025 markets that we track in the emerging market space. But the big benefit of India is, a domestic economy with trapped domestic liquidity, the banking system looking interesting from a loan deposit ratio, a credit cycle can emerge. I'm hoping that the investment cycle finally gains a foothold. So I'd say, India is in the middle. Because it is an oil importer, though I'm not very worried about the food price inflation in India being a domestic food market. I do think that India will follow US markets though, because the correlation of the Indian market with the US market has only increased over time. So it will follow the patterns in the US market.
All right, so then let's discuss US markets first and, time permitting, come back to India. Jitania, one of the big worries now has been this yield inversion. Now, the 5-year yield was higher than 30. Apparently, that's not happened since 2006. And now even the 2-year went over the 10-year briefly yesterday. Do you think that we are in for recession, that growth could take a beating in the US?
So I'll answer this in 2 bits. So the yield curve, the different yield curves are saying different things. So while the 2 and 10s inverted today for a very short period of time, the 3-month 10s is still steep at about 200 basis points. So this kind of disconnect has not been seen in the last many, many years. So I think this time is a little different because of the quantitative easing that has been unprecedented as an economic policy experiment. And I'm not very convinced that the yield curve at this point is signaling a recession. And I think there are fundamental reasons. The US consumer is in a much better shape. US consumer has $2 trillion of savings because of not using them on services, because of the pandemic and all the government handouts. The energy intensity of the economy has come down over the years. So it takes more of an energy increase to have an impact on the economy. And after 50 years from the 1950s, the US has turned from being a consumer or a net importer of energy to a net exporter and a producer. So the consumption offset with the oil price increase, that the producer side of the economy will help that. So I'm not really worried. I'm not in the recession camp yet, unless we see more disaster and more oil price hikes. But I'm not in the $150, $200 oil price view as well.
Oh, right. That's good to hear. That's really good to hear. And also good to hear that if you think that the US is not headed for a recession and India is pretty integrated with the way US markets move, that also means good news. The other argument I thought was that in the 2004 to 2008 rate hike cycle, the US economy didn't slow down till yields went up to 4%, or rather the Fed rate went up to 4%. So even going by that, should we believe that US growth will slow, or US markets will not perform well later this year?
So US growth will definitely slow, and we must keep in mind that we were already growing above trend growth because we recovered from a pandemic, and US trend growth is 2.5%, and we're still growing much higher than that. So we will slow. There will be a slowdown. And I think what's really important for markets is going to be earnings. But the other piece here is the midterm election year, right, in the US. So in the history of election cycle, midterm election year is always a volatile year. And this has been a pattern which has been consistent in every presidential cycle. And I think that means a volatile year. The average drawdown in the S&P in a midterm year is 18%. Versus between 12 and 13% on an average year. So I do, if history is a guide, I do worry about that just as an event study, the fact that we are still getting adjusted to the new reality of inflation, to quantitative tightening. The Fed has said taper, hike, and then sell securities. So we're going to go through that part, and that's going to be volatile. So I think markets will reflect that reality.
Okay, so volatility ahead. Well, we have to take a break, Jitania, but we have lots more questions for you on how will commodities trend here on and which would be your favorite markets within the EM basket. All those questions to Jitania in a minute after this break.
When I